Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris, to talk all things bonds. Tom, how are you doing today?
Doing great. It's a pleasure to be here.
Yeah, thanks for joining us. It's a pleasure to have you. Let's start high level. I think probably the number one question lingering over markets today is, have we hit peak inflation, and therefore have we hit peak yields? And so I'm curious how you would handicap a question like that.
Yeah, well, I think if on the first question, have we hit peak inflation? We very likely have on a CPI, headline CPI basis. We're likely to start rolling over this month and possibly even see a revision lower to last month's numbers. But that's on headline CPI. Core CPI, core PCE, the more core measures are likely to continue to be drifting a little bit higher. But we'll very likely have seen peak headline inflation at this point in time. What that doesn't mean, though, is that we've seen peak yields, at least depending on what part of the yield curve you're looking at. If you're talking about the 10-year part of the curve, you've probably have seen the peak yields for this cycle somewhere around a 350 where we hit back in the middle of June. But on the front end of the curve, you're probably looking at yields continuing to drift higher at least until the end of this year, if not into early next year, because we think the Fed is going to terminate the Fed funds rate somewhere around a 350, maybe even a 375. So we have further to run on the front end.
Right, so further to run, but the market is already pricing in rate cuts for 2023. They're saying that the Federal Reserve will hit peak Fed funds rate sometime in the early part of the year, and then by the end of the year, there will be several cuts. Do you see that happening without a deep recession next year? I mean, the Federal Reserve governors have already pushed back on this a little bit, but how would you address how the market is pricing the path of rate hikes and rate cuts for 2023?
Yeah, I think a first quarter, even second quarter rate cuts seem way too optimistic at this point. The Fed has really never been that quick to cut after they've terminated the Fed funds rate. It's typically might take more like 9 to 12 months before the first cut might come. But even if the cuts come next year, I wouldn't see them coming until the end of next year, because the Fed has learned from its mistake from the 70s. Start-stop tightening is a big reason why we saw stagflation in the 70s and had to be beaten down with excessive rate hikes in the early 80s. So I think the Fed is going to move to a terminal rate and hold there for quite some time. And what that means is for rate cuts, I think the earliest we're looking at rate cuts for next year would be fourth quarter. I just don't see first or second quarter rate cuts coming in. It would have to be an extremely deep recession triggered by other events, perhaps external events, to get rate cuts in the first half of the year.
That makes a ton of sense to me. So we've kind of painted a picture of the macro landscape. And so now the question I have is, how are you positioning fixed income portfolios in this environment, and particularly along two key spectrums, duration and quality? Are you moving up or down?
Yep, so we have been moving up in quality and increasing duration as the year has progressed throughout 2022. We started the year in our core strategy about a year and a half short duration versus the ag. We've since trimmed that to about a quarter of a year short duration. So we've moved up in duration. Along the way, we've completely trimmed our exposure to bank loans and high yield, and have moved up in credit quality to investment grade corporates and to treasuries. So we're fairly conservatively positioned at this point in time. And for the most part, we've taken good advantage of these tactical moves in both yields and spreads throughout the year. Now, looking ahead, we're at a point here where we do see a recession coming, perhaps as soon as before the end of this year. So we do think we're going to see spreads widening out again at least one more time before all is said and done. So we're looking for an optimal exit point from some of those credit spread exposures that we've added throughout the year. But I would stress we've moved up in credit quality. We've moved out of the high yield space because we look at this as albeit a shallow recession, a recession nonetheless, and economic weakening still to come.
Great. Okay, final question. You've written extensively on the two types of tightening the Federal Reserve can implement. So there's interest rate hikes, which we've covered extensively, and then there's balance sheet reduction, which you've written you think is being underutilized. So could you talk a bit about that dynamic, and then also should balance sheet reduction accelerate in the coming months and years, what that might mean for fixed income markets?
Yep, and to be quite blunt, we've been a bit critical of the Fed here in the slow pace at which they've been reducing the balance sheet. We view that as a very real policy mistake, not any less significant than the mistake of waiting too long to raise rates in the first place. With that said, balance sheet reduction is set to accelerate in the end of the third quarter, beginning of the fourth quarter of this year. So you should start to see the balance sheet begin to reduce at a more rapid clip by the end of this year. But it's a little too late at this point in time, and you've already seen the consumer beginning to wobble based on confidence measures. And at the same time, you've seen tech stocks and growth stocks and treasuries as well rallying on the back of a lack of tightening using the balance sheet. So you're seeing the divergence between the real economy, the haves and the have-nots, the Main Street economy and the Wall Street economy. You're seeing that right now, and we would attribute much of that to the lack of use of the balance sheet. But what we stress to our clients is balance sheet reduction is still coming, albeit about 6 months after it should have started, and it's going to accelerate in the third and fourth quarter.
Yep, and too little, too late does seem to be a theme for the Federal Reserve this cycle, but something to keep an eye on for sure. Well, Tom, thank you so much for the time. It's been super insightful as always, and we really look forward to having you back sometime in the coming months. So thanks again.
Sounds great.